Welcome back for another deep dive with us. Today we're going back to the 1980s, to Wall Street.
Yeah, Wall Street in the 80s.
And specifically, we're looking at the rise of the insider trading scandals. It's really a fascinating period, so consider this, your fast track to understanding what was going on, who the major players were, and how these scandals really took shape.
You've given us some great material for this deep dive, really digging deep into what happened. And one of the sources we'll be drawing from is actually considered like the definitive book on the subject. It's been called the best book so far on the Whoring 80s and really praised for its like sturdy moral sense while also being really sensitive to all the ambiguities of everything that happened.
Yeah, I mean, it's a complex story. We're going to be looking at excerpts from this book and a couple of others to really understand how Wall Street was changing, the new players that were coming in, and the environment that ultimately allowed these illegal activities to flourish. We won't get bogged down in, every single detail, but we want to give you the crucial insights so you can connect the dots.
It's really about understanding the context, right? So let's start with what Wall Street looked like before things really blew up. You had these established firms like Kidder, Peabody, led by Al Gordon. Their culture was very much old school, focused on preserving capital, and they were really hesitant about hostile takeovers.
So hostile takeovers at that time were almost seen as like taboo. I mean, were they really that uncommon?
Yeah, they weren't exactly embraced by the more traditional firms. The book refers to them as like the WASP investment banks, and they often preferred to leave that kind of work to other firms, many of them, Jewish owned or operated.
Wow, that's interesting. So this reluctance from the old guard, did it create opportunities for new players with different approaches, people who are more willing to, shake things up a bit?
Definitely. And within Kidder Peabody itself, you had Martin Siegel, who was ambitious and, unlike a lot of his colleagues, really embraced mergers and acquisitions. He'd had early success working on deals for guys like Charles Bludorn of Gulf plus Western and Victor Polnieri of Penn Central. He even wrote a textbook on M&A back in '74.
So he was ahead of the curve in that sense. And his role went beyond just structuring the deals, right? He was also evaluating the impact of these huge stock purchases that often came with, takeover rumors or bids. That must have put him in contact with a very specific breed of Wall Street operator, arbitrageurs.
Exactly. These were the traders who were constantly looking for those tiny discrepancies in the prices of the same asset in different markets. It was a fast-paced, high-volume game, and the descriptions of them are pretty vivid. They were seen as like crass, excitable, street-smart, aggressive, driven by the potential for making quick profits. Their days were intense, filled with trading and information gathering. Then after the closing bell, they'd unwind at bars like Harry's, near Kidder, Peabody, or more upscale places if they had a really good day.
Sounds like a high-pressure, high-reward lifestyle.
Absolutely. And speaking of high reward, that brings us to Ivan Boesky. He'd made a fortune in the arbitrage world. His firm, Ivan F. Moscato, grew from a relatively modest initial investment to nearly $90 million in capital.
That's a huge jump.
It is, and his success was definitely reflected in his lifestyle. He had a Westchester estate, a Manhattan townhouse, even a chauffeured limousine, like the image of Wall Street wealth.
Yeah, the book really dives into his personality, too, with some pretty interesting anecdotes, like the puppy incident, where his new puppy had an accident on his pristine beige carpet. And apparently he completely flipped out. It almost reflects this need for, like, absolute control in all aspects of his life.
Right. And then there are the description of his eating habits, almost like he was constantly restricting himself. There's a story where he takes a tiny bite of a croissant, and a colleague even jokes, "Ivan, you little pig." It just paints this picture of a very eccentric and intensely focused individual.
So we've got these established players. We've got the rise of the arbitrageurs. But then there's another force that's really starting to reshape Wall Street. Drexel Burnham Lambert, and specifically Michael Milken. Now, initially Drexel Firestone, they weren't part of that old school establishment. When Fred Joseph came in, his ambition was to make Drexel a major player.
Yeah, and he was starting with, not much. In the corporate finance department, they had 19 people. He immediately fired 7 of them, and the total bonus pool that year was only $15,000. He knew the old Wall Street was vulnerable, and he was ready to exploit that.
And at that point, Michael Milken was already at Drexel, though focusing on a slightly different area, right?
Right. He was heading convertibles and what were called non-investment grade securities. Eventually, those would become known as, high yield or junk bonds. But interestingly, Joseph wasn't really that impressed with Milken when they first met. They were operating in different parts of the firm. Milken reported to a longtime Burnham trader and for compensation directly to Burnham himself.
For those who might not be familiar, what exactly are junk bonds in this context?
Well, they're bonds issued by companies that have lower credit ratings, so they carry a higher risk of default, but they also offer potentially higher returns to investors to make up for that risk. Traditionally, they were seen as less desirable investments.
Okay, so Milken was dealing in these riskier but potential more rewarding securities. How did he prove himself to Joseph?
He managed to sell a $30 million junk bond issue, and the underwriting fee was a hefty 3%. So, that definitely caught Joseph's attention. And he didn't stop there. Milken went on to pioneer high-yield mutual funds. The source notes that this was a big deal because it allowed smaller investors to get involved in these lower-grade debt offerings, which had traditionally been kind of like off-limits to them.
So Milken was challenging the old way of doing things, democratizing access to certain types of investments. But at the same time, as these new players and new financial instruments were coming in, the seeds of these illegal activities were also being sown. That brings us to Dennis Levine and his secret Swiss bank account.
Yeah, Levine was working at E.F. Harton at the time, and back in 1980, he set up this account at Bank Lou International in the Bahamas. He even used an alias, Mr. Diamond, which was his mother's maiden name, and the level of secrecy he demanded from the bank was pretty remarkable.
Like, what kind of secrecy we're talking about?
He insisted on communicating all his trading instructions via collect phone calls only, identifying himself only as Mr. Diamond. He wanted the account solely under that code name, fast execution of trades spread across different brokers, no communication from the bank unless he initiated it. All records and statements were to be kept at the bank.
So he was clearly trying to cover his tracks.
Definitely. And as these individual stories are playing out, we also start to see some early interactions between some of these key players. There's an interesting exchange mentioned between Boher and Jerome Mulheron where they're talking about money and Boheron just about principle. Mulheron just bluntly replies, "The money is your principle."
That pretty much sums up the driving force for many of these players, right?
Yeah. And this all takes place against the backdrop of what the book calls the greatest takeover boom in American history. The shift in investor focus towards company earnings and price earnings ratios throughout the 70s had created this environment where undervalued companies were seen as ripe for acquisition.
But even amidst this boom, there were moments of potential disaster, like the collapse of the city service deal in '82, which almost ruined Boesky. He'd invested heavily expecting a bidding war, but then Gulf Oil backed out. The stock tanked.
What's interesting is Boheron's reaction, though. He felt like it wasn't his fault. No one could have predicted Gulf's decision. But the book mentions that the very night the stock collapsed, the Boherons still hosted a dinner party at their estate for Mulheron and others. It's like this surreal image of, trying to keep up appearances while facing potential financial ruin.
Trying to project that everything's fine.
Exactly. But that near miss seems to have been a turning point for Boesky. Soon after, he has that crucial meeting with Martin Siegel at the Harvard Club. This is where their illegal partnership really starts to take shape.
Yeah, the setting itself is kind of symbolic, right? The Harvard Club with its air of establishment respectability, something Boesky clearly wanted to be a part of. Siegel, on the other hand, with his low tolerance for alcohol, probably wasn't as impressed by the ambience.
Right. The conversation starts off casually, but then Boesky steers it towards Siegel's financial pressures, his anxieties about his career at Kigger, Peabody. He brings up the job offer again, even suggests ways to help Siegel and his father out financially.
Sounds like he was really laying the groundwork.
He was, and then it shifts. Boesky starts implying that Siegel could, provide him with information. There's no explicit mention of illegal activity or payment, but the understanding is clearly there. And Siegel, needing an edge to compete with the bigger firms, starts to see the appeal of this arrangement.
So what would Boesky gain from having this inside information? What kind of advantage would it give him?
Advanced knowledge of potential deals. He could essentially front-run the market, buy shares before any public announcement, then profit when the price jumped up. That's why it was illegal, right? It gave him an unfair advantage.
Makes sense.
And Siegel, he rationalized it, focusing on the value of Boesky's insights and the potential benefit to his own clients. He needed Boesky to take positions in stocks to create that buying pressure, even to put companies in play so his clients could rate them.
Okay, so we've got this partnership developing between Boesky and Siegel. Meanwhile, Drexel Burnham Lambert, with Michael Milken at the helm, is also gaining momentum. We hear about their involvement with Victor Posner and Fishbach Corporation, And even though Fred Joseph was technically overseeing the deal, the book makes it pretty clear that Milken was really the one calling the shots.
Absolutely. And that's further illustrated by the private placement of high-yield notes for Pennsylvania Engineering in '85. Milken managed to raise $56 million, but even his loyal clients wouldn't buy all the notes. A large chunk was taken up by a Milken protege and Drexel itself. They pocketed a $3 million fee on that one.
And then there's the National Can deal, where a Posner-controlled entity called Otter Creek starts buying up stock just days after the decision is made for a Drexel-financed leveraged buyout, but before any public announcement. Sounds a lot like insider trading.
It does, and while Posner ultimately doesn't acquire National Can, Milken still manages to save Posner's, struggling financial empire. It just shows his immense influence in the junk bond market. Meanwhile, Joseph's getting increasingly worried about Drexel's overdependence on Milken and his operation.
I mean, his worries seem pretty justified when you consider the lavish junk bond conferences Drexel was throwing. Sinatra even performed at one, which cost them like $150,000. It definitely generated business, though. By '85, these conferences were so sought after that even major clients were practically begging for invitations. And all this while Joseph trying to maintain a respectable image amidst all this rapid growth and high-stakes finance.
It's a delicate balancing act, and while these large-scale financial moves are happening, there are also these smaller, more direct acts of insider trading going on. Like with Dennis Levine and Robert Wilkes, their relationship evolves, and for Levine, their little game of trading on inside information becomes almost all that matters.
Like an obsession.
Yeah, he even calls it the holiest of institutions. And his rising position at Lehman Brothers, amidst all the turmoil there, gives him even greater access to confidential information. His lifestyle gets more extravagant. He spends $500,000 renovating his apartment. It's clear he's profiting from these illegal activities.
And this fro of information isn't limited to just Levine and Wilkes. Levine starts sharing confidential details with Boesky, specifically about an upcoming bid for A&R. At first, it seems like he's just trying to impress Boesky, maybe hoping to land a job at Drexel, but then Boesky reciprocates, sharing his own market insights.
It's a two-way street. But even the Siegel-Boesky partnership wasn't without its hiccups. At one point, Siegel gets suspicious that the courier who's handling their cash exchanges is skimming off the top. When he confronts Boesky about it, Boesky gets really defensive, but Siegel decides to let it slide, figuring he'll just up his demands later.
Practical, I guess.
Yeah, and Boesky continues to rake in profits, even without Siegel's help sometimes, like in the Gulf oil deal. But there's this telling anecdote about Lance Lessman, Boesky's head of research. Lessman suggests Boesky reach out to Siegel for information on a Kidder-Peabody deal, and Boesky just shuts him down, completely denies having any special relationship with Siegel.
Damage control.
For sure. And as Boesky's success grows, he attracts more media attention. There's that Fortune magazine feature story. This, along with the Peter Brandt insider trading case at Kidder-Peabody, which really hurt their reputation, probably made both Boesky and Siegel a bit nervous.
Yeah, that Brandt case was a big deal. It really cast a shadow over Kidder-Peabody. And in a somewhat reluctant move, Rolf D'Annunzio, the CEO, finally sets up an arbitrage department, putting the relatively inexperienced Richard Wigton in charge. It shows how arbitrage was becoming this, unavoidable force, even for firms that had previously been resistant.
Definitely. And the Pacific Lumber deal provides a clear example of how Boesky's training, potentially fueled by inside information, could benefit Drexel. His buying dries up the price, which benefits Drexel through fees and warrants, and Boesky's SEC disclosures conveniently leave out the true ownership in the position.
Hiding the details.
Yeah. And the coordination between Boesky and Milken is getting deeper. Ira Moradian, Boesky's operations manager, even has to fly out to California to reconcile trading records with Charles Thurner at Drexel. It highlights how complex and secretive their arrangements had become.
So by '85, Drexel's influence, fueled by Milken's highly confident letters and junk bonds, is undeniable. These highly confident letters essentially assured potential raiders that Drexel could raise the necessary funds through junk bonds, giving them the leverage to launch these huge takeovers. This is a pivotal year, a wave of hostile corporate attacks. Drexel's providing the financing for guys like Pickens, KKR, and Perelman to go after major companies.
And within Milken's inner circle, figures like Richard Sandler are playing key roles, showing unwavering loyalty. Even established players like Carl Icahn see the benefit of working with Boesky, suggesting he invest in Gulf plus Western, appealing to Boesky's growing ambitions.
So by late '85, Boesky, still hungry for more, turns back to Milken. They hash this ambitious plan for a massive arbitrage capitalization, using Milken's junk bond machine to create almost $1 billion in capital for Boesky. Imagine the buying power that would give him.
It's a huge deal, and it leads to this, very questionable transaction. A $5.3 million payment from Boesky to Drexel disguised as a consulting fee. Lowell Milken and Donald Balser even draft a cover letter to explain it away. And despite all the red flags, Boesky's advisors assure him it's all perfectly legal.
Yeah, right.
Meanwhile, Drexel's tactics in these leveraged buyouts are getting more and more aggressive. Deals involving Staley and Winn-Dixie really worry Fred Joseph. He's starting to feel like the high-yield department's out of control.
Losing his grip.
It seems that way. Milken, on the other hand, seems to be reveling in his power. He boasts about bringing together these vast pools of capital. In a brief but intense meeting with Siegel, he even remarks that his only challenge is finding people like you, leaving Siegel with this impression of Milken as this potentially dangerous but undeniable force, almost like a financial sun god.
Powerful image. And for Kidder, Peabody, the financial pressures and the growing cloud of suspicion eventually lead to their sale to General Electric. Al Gordon retires, marking the end of an era for that firm.
Meanwhile, that initial investigation into suspicious trading activity at Merrill Lynch connected to a Bank Lou account is gaining traction. This investigation, involving brokers Zubilaga and Campbell, starts to uncover potential links to insider trading.
But it's important to note that at this point, insider trading wasn't really a top priority for the U.S. Attorney's Office in New York. They were more focused on organized crime.
Yeah, but that Bankaloo investigation is about to change things. On Friday, May 9th, 1986, Dennis Levine is arrested at the Gulf Plus Western building just hours after his name is given to Assistant U.S. Attorney Charles Lynch. He'd been lured there under false pretenses, and his reaction when they confront him with the evidence is pure shock.
Caught red-handed.
Pretty much. And almost immediately, Levine agrees to cooperate. He starts giving up information about others involved, even hinting at someone bigger than himself.
Flipping on his associates.
Yeah, and his information proves valuable. Robert Wilkes backs up key parts of Levine's story, painstakingly reconstructing details about the Russian, who's Boesky, and Wally, who turns out to be Ira Sokolow. They even have Wilkes make a recorded call to Sokola, but it doesn't really lead anywhere because Wilkes had already tipped him off.
So they're closing in on the bigger fish now.
Exactly. After Levine agrees to plead guilty, Lynch and Carberry set their sights on Boesky. They start digging into everything they can find on him, his book, media coverage, building their case.
And then there's that interesting twist with Harvey Pitt.
Right, Pitt's Bank Lou's lawyer, and he reaches out to Lynch, initially about the bank, but then reveals he's also representing Boesky and wants to negotiate subpoenas. This leads to a meeting with Boesky and his lawyers, and Boesky's nervous demeanor pretty much gives away that he's about to cooperate.
Cracking under pressure.
It seems like it. Boesky agrees to plead guilty and pay a hefty penalty in exchange for potential leniency. And the government, knowing that those Boesky might implicate, will probably start trying to cover their tracks, prepares a whole bunch of subpoenas to be served right after the announcement goes public.
So they're ready to move fast.
Yeah. They set the announcement for Friday, November 14th, simultaneous press conferences by Giuliani and SEC Chairman Shad. But that same afternoon, Ira Moradian at Boesky's firm discovers something really strange. Boesky's been quietly liquidating his portfolio for months, with the selling increasing rapidly in the past couple of weeks.
So he knew something was coming.
It certainly looks that way. The reactions to Boesky's cooperation are all over the place. John Mulheron feels betrayed but still offers support, which Boesky basically ignores. Drexel, on the other hand, goes on the attack immediately, portraying Boesky as a traitor and hiring a private investigator to dig up dirt on him.
Trying to discredit him before he can do any more damage.
Exactly. And the media goes wild. Reports come out that Boesky's actual illegal profits were way higher than initially disclosed. It becomes a huge scandal.
And for Martin Siegel, the net is closing in. His lawyer, Lawrence Pedowitz, tells him the U.S. attorney knows about the letter connecting him to Boesky. The next morning, Pedowitz confirms they know about the whole scheme. Siegel completely breaks down, confesses everything.
It's a devastating moment for him. He confesses to his wife, Jane Day, who's obviously heartbroken. And ultimately, he decides to cooperate with the government, too. He knows they have a strong case against him, multiple witnesses, and they already know about his connection to others, including Sokolow and Wigton. Cooperating seems like his only option.
So now they've got Siegel on board.
They do. And to protect his family from the media frenzy, they advise him to relocate, so he ends up moving to Florida. Meanwhile, there's a lot of infighting going on within Milken's legal team. Different firms representing him, and there's a lot of mistrust between them.
A house divided.
You could say that. And there's a crucial mistake made by Fred Joseph. Milken's lawyers managed to prevent Drexel from interviewing Milken himself. This really hinders Drexel's ability to understand how bad the situation really is.
A major misstep.
Definitely. And despite Milken's refusal to cooperate, the government keeps gathering evidence. Moradian's counterparts at Drexel, Charles Thurner and Donald Balser, start cooperating, corroborating the allegations against Milken.
The walls are closing in.
They are, and then there's this dramatic show of force. Richard Wigton and other arbitrageurs at Kidder Peabody are arrested. These very public arrests sent shockwaves through Wall Street. It's a message from the government that they're serious.
Making an example of him.
Exactly. Giuliani holds a press conference afterwards, warns that this is just the beginning, calls it a very long and substantial investigation, and urges others to cooperate. And for Siegel, Judgment Day arrives. He makes his preparations, calls his driver, his mentor, Martin Lipton. Then he goes to court and formally pleads guilty. His sentencing is set for a couple of months later.
And the fallout at Kidder Peabody is immediate. GE, the new owners, launched their own internal investigation.
It's chaos, and behind the scenes, there's actually debate within the U.S. Attorney's Office about their aggressive tactics. Some are worried they've gone too far, but they push ahead anyway, and that's demonstrated by the raid on Princeton Newport. It's a clear sign they're not letting up.
Full steam ahead.
Yeah. Drexel, for their part, initially remains defiant. They've got loyal clients, but new business is drying up. Expansion plans are scrapped. The investigation into Mulherron continues, led by Robert Baird now, and Boesky testifies against him before a grand jury. And finally, in March '88, Boesky starts his prison sentence.
So he's the first domino to fall.
You could say that, but there's still a lot of loyalty to Milken out there. One of the employees at Princeton Newport, Jones, faces perjury charges for denying illegal parking activities. She remains loyal to Milken despite the risks. At the same time, a PR strategist, Linda Robinson, is brought in to try and improve Milken's public image.
Trying to control the narrative.
But then Connie Bruck's book, The Predator's Ball, comes out, and Milken is furious. He tries to stop its publication, but he fails. The book paints a very unflattering picture of him and Drexel, and the government, meanwhile, is threatening Princeton Newport with RECO charges, but James Regan, the head of the firm, isn't backing down.
So it's a standoff.
In a way, some of Milken's associates start cooperating with the government, while others remain loyal but refuse to lie under oath. More damaging evidence related to parking is uncovered, but Milken's lawyers basically ignore Drexel's concerns. And then there are these suspicious payments related to warrants that raise red flags for Kogut, Drexel's president. He's worried about potential self-dealing or bribes.
It's all starting to unravel.
It is, and Milken's becoming more and more isolated as Wall Street's focus shifts to the massive RJR Nabisco leveraged buyout battle. Within Drexel, there's a huge clash between Don Engel, who's fiercely loyal to Milken, and Fred Joseph, who's trying to save her firm. Drexel's board rejects a settlement offer from the government, and then they have this final Christmas party for the corporate finance department, like a last hurrah before the inevitable.
The end of an era.
Definitely. And all that negative publicity that Robinson Lake had been trying to prevent comes flooding in after Milken finally pleads guilty. He becomes the poster child for the excesses of the 80s. At his sentencing hearing in November 1990, the government really lays into him, and he's given a 10-year prison sentence.
The hammer falls.
It does. But even after all the penalties and settlements, there are still questions about how much Milken is really worth. The complexities of his partnerships make it more impossible to say for sure.
So much hidden wealth.
Exactly. And as we wrap up this deep dive, it's clear that understanding how Milken and Drexel operated is crucial for understanding this whole era. There are a lot of great books out there that go even deeper into these scandals if you're interested.
Definitely worth exploring further. So to recap, we've seen how Wall Street was changing, with new players and new financial instruments coming in. We've met some of the key figures like Siegel, Boesky, and Milken, and we've seen how the seeds of these illegal activities were sown and how the initial reactions played out. It was a period of immense change, driven by ambition, but it was also the beginning of a major reckoning for Wall Street.
A reckoning that's still relevant today. And that brings us to our final thought for you. How do the dynamics and pressures we've seen in these early stages of the insider trading scandals resonate with the financial world today? What lessons can we draw from these events about ambition, ethics, and the pursuit of wealth and power? Take a moment to consider the human element behind all these financial maneuvers and the long-term consequences of decisions that might have seemed insignificant at the time.
We encourage you to explore the full stories of these individuals and the broader context of the 1980s. It's a fascinating and cautionary tale. Thanks for joining us on this deep dive.
Thanks for listening.
See you next time.